Hello everyone, this is Terry with Futures.io, and as always, I'd like to thank you for joining us today. It is my pleasure to welcome back John Hoagland and Dan Hodgman from TopstepTrader for today's webinar, Fireside Chat with Seasoned Futures Trader. Throughout the webinar, if you have a question, please feel free to type into the questions box. We'll do our best to answer them throughout the event. The webinar will be recorded and posted on the Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up. If you enjoyed the webinar, as always, feel free to share, comment, subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I will hand it over to John, and you'll get the pop-up to share your screen again. All right, she looks good. She's all yours.
All right, thanks, Terry, and thank you all for attending today. We're looking forward to having a informative and entertaining webinar for you today. I'm John Hoagland. Dan, you're with me, right?
I'm here.
All right. So a lot of folks probably keeping their focus on the earnings coming out. Apple just came out, beating both earnings per share and revenue. Lots of big earnings today. It's an interesting trading day, especially after the GDP number came out this morning. I think a lot of folks were a little surprised on how resilient these U.S. equities markets are. Dan, what do you think about that?
You know, it's really spectacular. Sitting here watching what's going on right now is it's amazing. We just had worst GDP pretty much ever, it feels like. We lost a third of this economy, and yet here we are, NASDAQ pushing that 11,000 mark, just 120 points away. S&P's holding strong, up above 3,200. Dow well above 26,000. I mean, these are astronomical numbers that we're talking about when it comes to these equity markets, and we're in such a questionable period or time for these markets, and yet they're showing such resilience right now.
Just another way to attend that the memory of the trader is relatively short, wouldn't you say?
Is it the trader, or are we just trading what we're seeing, and it's these markets that don't even care?
I guess, man, and the earnings are not all that bad, certainly not today. So, well, why don't we jump in, Dan? I'm going to introduce myself. My name is John Hoagland. I'm the senior performance coach at TopStep. I much prefer middle-aged performance coach, but I guess if the shoe fits, we have to wear it. More than 38 years of futures industry experience, not necessarily all of them actively trading. I started on the floor of the Mercantile Exchange in 1983 as a runner. Worked my way up, got hired as a proprietary trader along the way, funded my own account for a while. I became a filling broker in the S&Ps for a couple of decades. And like everybody on the trading floor, as opportunities dried up, I had to make that step and try to migrate to screen trading. I stepped out of the pit the last time in 2009. It took a year for me to relearn futures trading. I think on screen I wasn't going to be able to see the things that I was able to see in the trading pit, especially when all of the business and information was being transacted in the trading pit. So it took a year before I took a live trade, and it was about a year after that, in 2011, I think, when I met Michael Patak and Eddie Horn and Melissa Footlick, and they were putting together TopstepTrader, and I loved the idea at the very beginning because people weren't going to be able to learn about futures trading or trading at all in the same way I did, just from the ground up on the trading floor. And I thought that the TopStep was an excellent way for people to begin to learn to professionalize their trading in a safe environment. And I've been with TopStep since 2011. I've had the opportunity to speak to literally thousands of traders about their experience, about their journey, and hopefully I've helped as many of them as I can. It is something I relish. Nothing makes me happier than to see somebody succeeding past a level that they've never been able to succeed past before. On that note, I'll hand it over to Dan.
Thanks, John. Hey, everybody, I'm Dan. So I've been around this industry basically since the day I was born. Some of you may have heard the story. I always joke about it. I think it's hilarious. Day after I was born, my dad had to leave the hospital because the bonds broke, and my name changed from Patrick to Daniel. Something funny about that, I mentioned this the other day. John and I were talking, and this came up. And yesterday afternoon, my dad called me and said something got sent to him or sent to me that was supposed to be sent to him. And he goes, "This is why your name was supposed to be Patrick." So it's pretty comical. So I've been around the industry my entire life. I started working on the floor as a little kid, just running cards and learning how to trade check when I was about 10, 11 years old. As I got a little bit older, I worked on the floor in the summers, started hedging for a team of options traders until I was old enough to start trading myself. So I traded on the floor from the time I was 18 until I was 21, and then I went and joined the Marine Corps, thinking that was the best option. And while I was in the Marine Corps, I just started to manage my own futures account, kept it small, looking to make some of that, make some money on the side, and stay engaged in the markets. And then I got out of the Marine Corps and went back to the trading floor. I was down in the 30-year option pit, where I was at for just a little while before I realized it was time to focus on the screens. Floor wasn't going to be around forever, and so I went up into the office and I started trading yield spreads. I worked with a bunch of natural gas spread traders. I managed a euro-dollar algo, and then I've been trading my futures accounts that I opened up when I was about 17 ever since. And I've been here at TopStep since 2017. I'm very passionate about the program. I am here strictly because I think traders need to help with managing that risk. The last thing you want to do is see someone put that life savings on the line and risk it. And I think with TopStep, it's a great place to start to learn, work on that risk management. Reason I left the prop firm that I was at was we had a trader trading outside of his rules and took a large 7-figure loss. And my job was to close out that position. So I essentially realized that big loss and took a toll, and definitely opened my eyes to the risk that this industry has. And so being here at TopStep, working with traders, helping them understand that risk management and not having to watch them risk their own capital is a big thing for me, and I really am passionate about it.
Yes, excellent. So Dan and I have a couple of things in common. Dan's dad was on the floor of the Chicago Board of Trade. My dad was on the floor of the Chicago Board of Trade. My dad was in the grains. Dan's dad was in the Treasury options. My dad's dad was a cash grain trader way back in South Dakota, Iowa, and Nebraska. So it's kind of funny how Dan and I ended up sitting in the same room. Well, at least we used to be sitting in the same room, working from home now. We don't get to spend the time together that we did. But when I met Dan and I met another guy that works for TopStep, Mick Aronimo, who's our risk manager, we discovered that the house that my dad retired to was about a mile away from Dan's dad's and Mick's dad's up in Lake Geneva. So now not only do I get to see them in the office from time to time, I get to see them when I get to go to Wisconsin and hang out with them. So I'm of, I guess, a little bit older generation, but they still let me hang around with them once in a while. So Dan was talking about, the importance of risk in futures trading, and that's why whenever we do a presentation at TopStep, even if we're not discussing the buying or selling of any futures, forex, options, security of any kind, we like to put this up, not only because our lawyers insist we put it up, but because it always reminds me of the respect that I have to have for the risk in trading. Futures trading, forex trading, trading in general, it does contain risk. There is the chance that you can lose your stake, you can lose your account, you can lose money that you don't even have yet. So it's important to remember, do not risk capital that you cannot afford to lose. Something that many people that I have spoken to in the past, a mistake that they have made. I've talked to many people who put 10, 50, 100, even more into trading accounts and have lost that before realizing that the risk is something that they certainly want to respect, and that there's always something we don't know that we don't know. So we're not going to be talking about buying or selling of any particular products. There is no guarantee of past success continuing into your future. So we certainly suggest looking at trades and thinking about trading from the risk side first. Hypothetical or simulated accounts do have certain limitations. And I think the biggest limitation for just a random simulated account is there's no accountability. There's no consequence. There's no risk. It's very easy to make decisions that might be very difficult when you have risk on. That's why I believe the trading combine mimics that. I think it's much more difficult to trade in the trading combine than it is a random sim account. And if you think trading is difficult in a sim account or the trading combine, wait until you go live. It's a whole different thing. It's a whole different decision-making process. So we want to give you the opportunity to steel yourself to that process and to that decision-making process before you actually get live. Enough about that. We're just going to talk about some of the things in the markets and some of the things that our funded traders have been doing to help themselves succeed. Dan, how would you like to open up on this?
Yeah, I think it's combining the two. Right now, 2020 has been, well, a wild year, and I think that's an understatement. It has been unbelievably hectic, and so I think talking about that and where we're at with our funded traders this year, we have funded a record number of traders. I think we're well over 2,000 so far this year. And those traders, not only have we funded that many, we're seeing great performance out of these traders. If you happen to see our emails or some of the stuff, large payouts. We've had weeks where we're paying out with six figures to these funded traders. They're making great money. And I think it's all due to the fact that they have recognized the market state and scaled back a lot of what they're doing. I think we get so in tune when the markets were so much tighter and the volatility was sitting at 9 to 12, markets weren't making these big wild pops and these big wild moves. And so we started to see, myself included, a lot of traders started adding on size. And as soon as we saw the breaks start, we saw a lot of our funded traders, we saw a lot of traders just in general start to scale back on what they were doing, focusing on those A setups. We all have them. We all know when we're entering into the market, you have, even if you're not calling it an A, B, or C setup, you know instinctively, okay, this is a great setup. If any trade of today is going to pay me out, like this one is such a good setup. Those are the setups we're seeing these traders focus on, trading small, ones and twos, nothing huge. And it's helped create longevity in those funded accounts, and it's helped them pay themselves. And that's what we're all really here to do, is paying ourselves. I love the markets, but I got to say, I love getting paid from them too. It's kind of, they go hand in hand. And so I think that's what we're seeing with a lot of these traders and how they're handling this volatility right now.
100%. And along with reducing the size of the trades that they're taking, many of them that are the more successful ones have slowed down. Excuse me. They're taking fewer trades and profiting more from that. And from my experience, I wasn't trading in '87. I was a clerk in the S&Ps. One of the scariest weekends of my life, but I've survived through several major pullbacks. And one thing I've learned about them is if you get too excited, if you're too active, you're going to cut yourself up. It makes sense to me, and it makes sense to the traders that are succeeding in high volatility periods to slow down and look for those A setups in longer time frame, right? So slowing things down has helped our more successful traders. They're trading fewer, they're taking fewer trades, they're trading smaller. with the, with the volatility has fallen off quite a bit, we're seeing perhaps a little bit bigger trade size right now, and perhaps a little bit more activity. But it's the ones that survived the downturn that really, I think, have turned up the ability for them to continue to add bigger and bigger profits.
Great point, John. I think when the volatility spikes like this is something like this. Obviously, like you just said, it's come back a little bit, but over time, when we look back and we see this volume spikes, focusing on that higher time frame is, again, it goes back to that concept, we're here to make some money. If we focus on those higher time frames of what's going on, taking that bigger picture view, maybe looking at that hour or that 4-hour chart and getting in a better idea so we don't get lost in the chop of a 5-minute or a 1-minute chart. Sometimes we can take that perspective. I think it helps calm us as a trader too when we enter into the market. If we're looking too short a time frame, I saw a 5-minute chart someone showed me today, and they were saying this is why they got in and out. And I looked at it and I go, and I didn't see the time frame on it. And then I looked over at my charts and I had hourlies up. I'm like, gosh, I just don't see why you got shaken out where you did. There's so much more potential to the upside. He's like, oh no, I got up because of this swing high here. And as I looked at it, I was like, what time frame is this? And he said a 5-minute chart. And I go, oh, okay. So when we look too close like that, sometimes we're missing that big picture and realizing, you know what, there's not a ton telling me to get out on this 5-minute swing high. That's just in the middle of a beefy candle on an hourly chart or a 30-minute chart. And we miss those opportunities. If we take that bigger picture, that 30,000 foot view, and work our way down, we're going to be able to take advantage of some of these bigger moves, which I know every trader out there wants to be in on the big moves.
So the traders that have learned that patience and the ability to take bigger bites out of the marketplace have probably started from a different place than they are now. We hear a lot of traders looking at those very short time frame charts, even if it's only for execution. Maybe you're looking at the 30, you're starting it with the daily chart, you're recognizing market state in the longer time frame, you're looking for opportunities in a shorter time frame chart, maybe an hourly, maybe a 30-minute chart that's congruent with the bigger time frame direction. And then you look down to that 5-minute chart for finer execution. Now, I can't look at a 5-minute chart or anything shorter than that because it gives me heart palpitations. And so, but I understand, if you really want to kind of refine your entry in something like that. But if you keep your focus on a chart like that, it's the ones that are keeping that focus on that chart that are getting wiggled out of some of the bigger opportunities. Once you find your entry on that longer time frame chart, again, whether it's a 30-minute chart or a 1-minute or an hourly chart, once you find your entry on that 5-minute chart, minimize it and then trade to the longer time frame if you want some of those bigger opportunities. And for some of the traders that are succeeding with us, many of them started with those shorter time frames. They were very active traders. They were in and out, more of a scalping type mentality. But over time, I think that they've grown from that and realized, I can make money and trade less if I look at a little bigger time frame, bigger time frame chart. And it's one of the things, that we kind of connotate in a lot of the content that we put out. The true scalper from the trading pit was the guy that was on the bid and on the offer and just trying to buy the bid and sell the offer as close as possible. But that niche has kind of been taken over by the machines. And if you're going to try and trade in that short time frame, you're going to be fighting those machines, and those machines don't have emotions. They just do exactly as they're told. If they don't work anymore, believe me, these companies have strategy after strategy lined up to take over for the ones that are now broken. So, you know, the more successful traders at Top Step, I think, are, you know, we're day traders, but we're day traders that I think are looking to take some of those bigger bites out of the market and some of the longer time frame charts. Now, we all know that the top-down approach tells us in longer time frame who is, you know, what direction the market is attempting to go. You know, since the low has been in March, it's in the S&Ps, and in the equities, the market has been attempting to move higher and higher over time. And if you're going to fight that, you're going to get run over. As a matter of fact, I've been around the S&Ps for, well, almost 30 some odd years now, dating myself again. And if there's no bad news, the equities just kind of grind higher, and they grind higher on the backs of short time frame traders who are always looking for the big money on the big move to the downside. I think traders that are focusing on catching the big moves to the downside lose more getting run over because that community is too short all the time than they're ever going to be able to recover if they even have the skills to navigate a major pullback like we saw in March. And you know, we didn't have traders that were grinding themselves up to that point, and we had traders, you know, that were grinding out money because the market was grinding higher. You know, many of them, you know, had a much longer time frame, reduced their trade size, and were able to survive that pullback, which in itself is a degree of success in futures trading.
Absolutely. And something I've seen with our funded traders, the ones that are making this money and sticking around over time and really growing these accounts to large numbers, are the ones that have finally said, I'm done looking for the big breakout. I'm going to focus on what I can see right now. I can't tell you how many times I've sat down with a new trader, and anytime the market kind of came to, let's just call it an area of resistance, and the market's pushing a little bit higher, I've seen a lot of traders want to say, here comes the breakout, I'm going to buy this. And the market just turns right back around and maybe inches higher, slower over time. But because they're trying to get in on those highs to look for that breakout, they're getting stopped out so consistently. And then as soon as I see these traders recognize and say, look, I got to stop looking for that big pop. And you look at anyone right now looking at a NASDAQ chart, if it wasn't for earnings, would we be sitting here getting long on the highs that we've seen all day long that really just started to grind from about 11 o'clock Central Time and didn't do anything until these earnings came out here in the last half hour. You're not looking at that high and thinking, all right, I got to buy this thing, that breakout to the upside's coming. Chances are they're sitting there saying, look, we're on this high here. We haven't broken above this. Odds right now, or the percentage, are in my favor if I take a short and I look to bring this thing just kind of back down and maintaining this little channel that it started to create. When we start to see traders doing that is when I think that we start to see these traders growing these accounts and making those bigger payouts.
Yeah, excellent point. Breakout trades have always been a challenge for me. You know, it seems like 80% of them usually fail. If you're trying to buy the high looking for a continuation to the upside, you'd better be pretty quick to manage your risk in those situations. I had a point I was going to make there, and my old brain has lost it.
Well, I'll tell you what, as you think this thing through, something I do want to touch on is one of the things that we wanted to talk about today was just some of the steps these top performing funded traders are actually taking right now with this risk management during these strange times that we're in. And I know we've mentioned this kind of scaling back. We've mentioned focusing on these A setups. But I also think one of the biggest things that I've seen is just the total number of trades being taken. Our traders are now getting into these trades not nearly as much. They're not taking that scalping mentality, which to me, when I learned the term scalping, we would say we're going to scalp a 10 lot for 10 ticks in the bonds, and we were only risking 2 ticks, I'd look at that right now as a big trade in the bonds as well. So, and we were only doing 1 or 2 in a day, and those were really good payout days. When we weren't so volatile, these traders were taking a lot more trades, and then that costs on the back end. You know, you start to think about fees and commissions that come in for each and every trade that you're taking. If you can kind of start to rein in those costs of doing business, it's really going to help that overall P&L, which again, I know we're all here, and that's the thing that we're thinking about, whether we're saying we're not thinking about it or not. We're thinking about that P&L. It is such a big factor in everything that we do in trading. And if we start to focus on, all right, today I'm only going to take 2 to 3 trades. I'm going to focus on that A setup, and I'm going to execute on that, where knowing those A setups or those top setups for ourselves are going to present us great opportunity. And with that, when something for me, when taking those setups or when that market enters, for me, I like to look at it as markets entering into a specific zone or an area of importance or a level. When our market approaches that, I have to ask myself a couple questions that I run through. And this is something I try and teach a lot of traders is, okay, I have a bias that says the market's going to go higher. Great, if that's our bias, we got to forget that bias. We have to ask ourselves, okay, here's where we're at. We're in this level that's come into play multiple times over the last few weeks, and it's created good opportunity to the long side and the short side. As we approach that level, start asking ourselves, where's to get in this trade, what side keeps my risk as tight as possible? So if we can manage that risk, if we can get in and say we want to be long, but our risk is rather large on the long side, and our profit target isn't as big, but we look at it, we go on the short side, we say, look, on the short side, I've got really tight risk here. I'm going to execute to the short side because I'm focused solely on managing this risk and growing the account. For me, it's all about this process, focusing on the process. Every trade that we enter, that's what we're going to start to think about. Where's my risk? And is it going to be better if I'm looking in a different direction? If we can kind of just focus on what the market's telling us, that may help start to manage that risk over time.
And you jarred the thought that I was going to be talking about out of my brain now.
Oh, good.
The keeping the math on your side, always knowing where your risk is, where the point of invalidation is on any given trade is, of course, wildly important. We're all looking for bigger opportunities to profit than the risk we have to take. Dan, you were talking about scalping 10 ticks out of the bonds, but you were only risking 2 ticks to do so. That's a 5-to-1 reward over risk. Our funded traders that are succeeding are keeping that in their mind. You have to know where your point of failure is and try and trade as close to that point of failure of the trade or invalidation is. Another thing that they are doing is we have a specific loss limit that we impose on each account, and the funded traders that seem to be doing the best are stopping way short of the imposed daily loss limit that we have on these accounts. Recently, one of the traders that I think was really trading very successfully, he was limiting his daily loss to $300. So there may be a series of days where he would lose 300, lose 300, lose 300. But on the days when he was right the market, he could easily make $3,000, $4,000, $5,000. So just by keeping that discipline on a trade by trade basis and a day over day basis, and knowing that he was capable of finding these bigger opportunities over a series of days, he was able to build that account, to a level that I'm sure even surprised him.
That's great. It kind of goes to that whole, with baseball starting up and sports starting up in general, it's a matter of just chipping and chipping and chipping. The traders that struggle are the ones that are constantly looking to knock it out of the park or hit that home run. But the traders that focus on keeping it small, or the ones that are able to grow this account, I think our risk manager Mick says it the best. He goes, I'd rather see a trader make $100 to $200 a day and only risk $50 to $100 in those days and do that over time than a trader that's having the big 1,000 up and 1,000 down days, because you're just putting too much risk on the table. And I'll give a kind of a personal story. Reason I kind of mentioned earlier, we had a trader at a prop firm I was at. He was trading an oil product, not our standard crude oil, but he was trading a Texas oil product, and he had a plan that he was supposed to stick to, and it was agreed upon with the owners of the firm, and he deviated from that plan. And in deviating from that plan, it all came out that it ended up going multiple seven figures against. He ended up burning out most of that firm strictly because he deviated, and that has a major trickle effect. And so now for me, when I sit here and say we have to kind of create this discipline and sticking within those plans, it's going to help us grow over time and not put ourselves in a situation where we are no longer trading. And I think that's one of the most important things that we have to recognize as traders. I have it all written out all day long. I sit here at my desk, whether I'm in the office, I'm at home, which is my new office, is my home. I've got my hard cards out that I'm watching. I'm marking everything that's going on. I'm marking my levels, places that I'm looking for this market to react within. And that's my guide to my trading. And that helps me just kind of focus on the process. And that's something I've tried to relate to a lot of our funded traders. And I think the funded traders that are doing well right now focus on that prep, focus on that process or that system that they're sticking within. And that's how they're growing these accounts. Recently, we had one of our funded traders use his profits to buy the new minivan for the family. I mean, they're doing extremely well focusing in this process.
And not everybody starts that way. We all know how difficult this is. And one of the things that I discuss with personal performance coaching clients is even people that have some experience and maybe have had a degree of success at some point, is the human brain is not necessarily wired to succeed at this. As a matter of fact, I think it's quite the opposite. Nobody likes to take losses. So when we put on a trade, and especially new in our career, and in the case of the prop firm, Dan, that you were talking about, that trader fell into a very difficult time where he could not take the loss. I'm sure he recognized that he was going to be taking a substantial loss, perhaps even putting the firm at risk, but he couldn't pull the trigger. He was still hoping, wishing, holding his breath, standing on his head, doing whatever he thought would make that market come back and make him whole again. And it's just not reality. The other side of that coin, folks, is when we start to get into a trade that is paying us, it's very difficult to stay in that trade to a known profit target, or even if there is no known profit target, you're in a long, early on a trend day to the upside. You don't know how far that's going to go. It's very difficult to stay in those trades. I think that's partially why I have a hard time looking at 5-minute charts, is because there's a lot of noise in them. So, it's of ultimate importance to change that wiring in the brain, is to be able to trade close to points of invalidation and to be able to get out if the market takes you to that point of invalidation. And the other side of that coin, especially after experiencing some pain from losses, it's difficult to stay in a winning trade till it comes to fruition. But the goal is, we always want to be looking for asymmetric opportunities, asymmetric in the fact that we're going to be looking for smaller opportunities, smaller ways to get into trades for greater profit opportunities. 2-to-1 reward over risk, 3-to-1 reward over risk. I've had people that I've worked with that have had some good success in the funded account just by telling them to try and experiment. They're really good at finding trade locations that are close to points of invalidation. What I wanted them to do was whenever they get into a trade that they can see a 2-to-1 reward over risk, they take the trade, they don't change anything. If they're capable of finding trades that are going to go and hit their profit target 50% of the time, they're going to be able to maintain and grow that account. One woman I suggested this to took it to heart. I told her, just treat it as an experiment. Don't even think about outcome or performance. Just take your trades at 2-to-1 reward over risk. Give me 30 instances and let's see how this plays out. Well, like I said, she was pretty good at finding cheap trade locations. In cheap trade locations, I'm talking about finding trades that are close to points of invalidation where your stop needs to be. And in 30 trades, she had succeeded in a 50K combine. She had 30 grand in profits in 30 trades. Doesn't sound like a lot, but it's something that she had not achieved yet. When she sent me the spreadsheet with the outcomes of these trades in ticks, I added everything up, and she had succeeded in that 30K, that 50K combine. I called her up. And I said, you did a really good job with this. I'm proud of you. You know what you did? And she said, what are you talking about? I said, you succeeded in a 50K combine. You're getting funded. And she started screaming into the phone. She took it so to heart that it was an experiment that she didn't even pay attention to the outcome. And that's one of the things Dan said, is it's all about the process. Now, I showed her that she was capable of doing this. And she got funded, and pretty sure she's probably still funded. I don't know. I haven't talked to her for a while. Problem with that is most people will go back to what they were doing before. Once they learn that they're capable of doing it, they think that they've got it and that they don't have to do the work anymore. And that tends to hurt some of the performance of what they've now learned that they can do.
That's a great story, John. John, I want to throw something at you here. As we're in the midst of earnings season, I think it's worth talking about. When you are approaching the earnings season, John, are you looking at companies individually? Or are you looking at kind of this overall viewpoint of how companies within, say S&Ps are doing? And how do you allow that to approach or affect your style or the traders you're working with?
Okay, I think it's very important to be aware of the earnings that are due out that day. Some of the earnings that came out today are, hugely impactful. I mean, the companies that came out today, I think, are 22% of the total market cap of the S&P. So you will certainly want to be available for when those are going to come out. And I don't trade into those situations. I don't trade into major economic releases either. I need to know what time they're going to be, and then I'm going to try and focus on what I see in the marketplace. But I think during earnings season, you want to keep a pulse, keep your thumb on the pulse of, in general, how the earnings season is going. Maybe not so specific as to specific companies, aside from the FANG companies. Yes, certain companies are going to affect it more than others. But I think, the futures markets take some time to digest some of the information from time to time. Now, who knows what's going to happen tomorrow? Obviously, with the FANG stocks that came out today, we've got a big up move, and everybody's thinking these things are going to go to the moon. But eventually, everybody's going to get too long, and it's going to turn around at some point. So as far as earnings are concerned, I'm not that concerned about which companies. I want to know the big ones, of course, and when they're coming out, so that I'm not going to be, possibly the wrong way. But I'm paying attention to the overall outcome of them as groups. The S&P is the broadest index, so that's going to be the hardest one to digest all the information, right?
Absolutely. I think that's great. I'm sitting here myself and just kind of looking at everything. I got out of my S&P longs right before the close here today, and definitely had that urge to stay in the position. But I said to myself, too much information's about to hit the fans here. I closed out my position, maybe missed out on about 30 points, give or take, in the S&Ps, but I'm okay with that just because it could have gone the other way.
100%. 100%.
Yeah, without a doubt. I think it's really important. You talked about economic releases there as well. Keeping that stuff in mind. If you're day trading and you're just trading outrights, you can't cover your risk during stuff like that. If the market goes against, it's going to go against you. There's nothing you can do other than take the loss. And so avoiding those emotional moves, which is what I call it, when the market has these
Exactly what
abrupt
they are.
moves, and chances are, you look at a lot of these moves, the market returns back to unchanged to what happened before that number or before that news hit the fan. But there's so much risk to be taken within that. We have to be cautious of that. And that's the approach I think you have to take whenever you are trading like this. If you're trading those outrights just like that, you cannot control that risk. Unless you're hedged, unless you're doing something to manage that risk, that, hey, if it goes against me, I'm okay. There's stuff I can do down below or up above to cover myself and make a little profit no matter what.
Yeah.
So it's really important to keep that stuff in mind.
Being in the trading pit, and, standing there holding a position, waiting for an important number to come out. I've had some wildly successful days. I've had absolutely tragic days. And if I were to add up the profits and loss of all those days, I'm about even. So I decided a while ago, and it's not worth it. It's emotional, it's a coin flip, and if you're the wrong way, you can lose a lot. I would say 50% of the gray hairs that I have on my head are from holding positions into major economic. And I don't want to do it anymore. It's again, it's a coin flip. People say you're crazy. There's great opportunity in them. I've seen the opportunity, and I've also had that opportunity shoved down my throat. So, over the years, if I'm even on them, I learned my lesson. I'm going to hold off. I want to know when they are. I want to be able to watch the response to them. And I believe the opportunity will come not from the knowledge of the numbers, but from the action of the marketplace.
Absolutely. I come from a different background. I was an options guy, and so we were ecstatic for all these major numbers. There were 2 days a week. A month you did not take off. You didn't take off unemployment Friday, and you didn't take off expiration Friday. Those were the days we looked forward to. FOMC, things that were going to bring this volatility is what we looked forward to. And so I had a really hard time going from options to futures and the back and forth, managing them separately. When I looked at futures, I was ingrained since I was a kid. My dad had unemployment pants that he wore for all 30 years of his career. They're disgusting and tore up, but he still has them. They were his unemployment pants. And so for me, growing up, everything I knew, unemployment was such a big day. When I started working on the floor, you did not skip unemployment. Now, focusing on strictly the futures side, I had a hard time in the beginning saying, oh, it's unemployment, got to be there, got to trade it, got to have my positions on. And now that I'm focused solely on futures and not doing too much in options, it's helped me guide myself, focus on, okay, that's not what I'm supposed to be trading. Yes, option was great opportunity, but this is what this product is right now.
I can remember standing in the S&Ps with a position on, waiting for the FOMC release, and my hands would be ice cold. My feet would be ice cold. My arms would be ice cold. The fear was so great about what was about to happen. When you're faced when a situation like that, your body reacts by pushing all of the oxygenated blood into the major muscle groups and into the major organs so that you're able to fight. And I could just never forget standing next to a guy, and I'd touch his hand, and his hand would be ice cold. My hands would be ice cold. Just the sheer fear of what was about to happen. I never want to feel that again. So it was so funny though. I mean, you could just feel your muscles were bigger and stronger because your body was pushing all the blood into them. Because again, of the fear of what was about about to go on.
Yeah, it says a lot. I mean, you definitely trading during times when you are having those feelings is not going to be the most ideal.
When you're in
John,
abject fear, it's difficult to even write a trade down.
absolutely. John, are we in here until 4:30 or 5 Central Time?
I think till 4:30.
Okay.
Yeah, 4:30.
Just wanted to double check because I know I don't want to forget any questions if we've got those. And I also know we have on the next slide, we've got some promo
Yeah,
codes and stuff or
let's do that.
something.
Let's do that. Talk
Awesome.
about the football.
Well, it is Top Step's 8th birthday. And for our birthday this year, we are doing packages. So if you are interested in the trading combine, whether FX or the futures side, you get a birthday package. And basically with that birthday package is you get a trading combine and one reset with that. Resets are there because we understand there are times where things don't go great and we maybe break a rule or have losses that we weren't planning on. So it comes with a reset there to help you get through the trading combine. So if you go to one of these links here, you can get access to these packages. I will sit here and stand by the program. I think no matter what skill level you are as a trader, the trading combine does provide an education. I will admit for myself, it helped me go from that prop mentality. When I was in a prop firm, we have a lot more risk. And when I focus on my own smaller account, which is nowhere near the prop firm, I looked at that trading combine and those rules and started applying them to what I was doing. And that really helped me manage that account and help me continue to grow that. And so it works for all experience levels.
100%. And part of these birthday packages is you're going to get a discounted subscription fee for your trading combine. You're going to get a reset, and that discounted subscription is going to last as long as you keep that subscription. As long as you keep that account running, you're going to get that discounted subscription fee. So it's a great deal if you've ever been thinking about getting into the trading combine. We're looking forward to seeing everybody succeed eventually through the trading combine. You know, maybe that's not a reality, but it's a goal that we strive for. It's our goal to try and help people professionalize their passion and professionalize their trading. So we'll look forward to seeing you there, hopefully. Now, we do have a couple of questions, Dan. Do you have anything else to say about the packages?
I was just going to throw in there on top of this, the trading combine, we also have personal performance coaching, which you can always sign up for with us as well. You can find that right on the website.
Yes. Excellent point, Dan. Thank you. All right. So we have a question here from a regular with our market forecast and our market recap level 2 has a question for us. John and Dan, do you guys consider the ES a true reflection of the economy at the moment? Talking about the September expiry. Dan, want to start?
Well, that's a great question. Up until about 5 months ago, yes, I did. I don't think our economy is as strong as these equity markets are right now. Obviously, we saw GDP minus 33%. I mean, that's a loss of a third of revenue and money movement throughout our country. But yet we're seeing equity markets as high as they are right now, approaching all-time highs. NASDAQ has recently been making all-time highs. So right now, I think I'm going to say not a true reflection, but I think a good guide to possibly where we can be economically.
Excellent, Dan. A couple of things that I would add to that is it seems as though the base of our economy, the companies that we're seeing earnings on, I think have not suffered that greatly, which is a bit of a surprise to me. But it doesn't hurt when you have a few $1 trillion thrown into the economy with the help of the Federal Reserve. So I think it's a big part of what's been propping up the stock market, and I'm hoping that the economy will catch up to the stock market instead of the stock market catching up to the economy.
Absolutely. Great point, John.
Thanks for the question, LT. LT has another question. This one, it looks like it's to me. I've been having a lot of success this calendar year. Can you advise on what a typical trader should do before they increase their lot size? Note, I don't want to over leverage or not over leveraging. This is something that I deal with quite a bit in personal performance coaching and even group performance coaching. This is a question that a lot of traders have. And there's really a lot of different ways to argue this. And some people are going to argue that I'm wrong. Some people are going to say, you know what, it makes sense to me. A new trader, I don't think has any business really trading any bigger than one contract until they're able to maintain the account. Now, again, there will be people that are going to disagree with me. Position sizing according to the risk on a trade is something that you want to consider. You know, if you're comfortable with $400 risk, you know, that's 4 points in the S&Ps. I'm sorry, if you're comfortable with $400 risk, that's 8 points in the S&Ps. But if you don't need that much room, you may be able to put 2 on and still risk that same $400 with 4 points of risk. That's going a little bit beyond what I was going to kind of talk about, but you know, you're having a bit of success this year, which is great. Make sure that your mind and your decision making is prepared to add more risk. Okay, if you're going to start with one contract and you become consistent and profitable, do that ad nauseum until you are so comfortable with the risk with that one contract. Then you can add the 2 contracts. You've added to your account. You're more confident. You're understanding markets more. Going from 1 to 2 contracts increases the risk at the greatest level. I think any trader should ever increase the risk. You're doubling your risk. If you can maintain and continue to grow that account trading 2 contracts, maybe you're going to double your income in that regard. You know, if your decision-making process becomes compromised because you have that extra risk on, it's going to show in your performance. But once you can consistently and for a long period of time maintain success or profitability with the 2 contracts on, do that ad nauseum until you finally get so confident in what you're doing with 2 contracts. Adding another contract is only a third, again, as much risk. It shouldn't be that more difficult, right? So, and then adding another contract and adding another contract and adding another contract. Point being, you want to be able to be confident in your process and in your strategy, so it won't matter if you're trading 1 or 10. But I got to tell you, as a 1-lot trader in the S&Ps, the first time a broker hit me and said 5, I was filled with fear. I couldn't even write it down. It turned out to be a great trade, and there were several locals around me that were willing to take parts of that trade, which of course they were going to be. It was a really good trade, but it took me a minute to just be able to calm down enough to write the trades down. So that's what I'm talking about is, you know, when you add risk, it changes the decision-making process. It's a little bit more difficult to make the difficult trading choices. So LT, you know, you know, we've known you for a while. You know, I know you've had some pretty decent success this year. Try not to go too fast. You know, when things are going right, you're never going to have enough on. When the market's going against you, you're always going to have too many on. That's a dad wisdom my dad told me a long time ago when I started trading. He says, you know what? When the market's going your way, you're never going to have enough on. So going against you, you'll always have too many. And it's true if you're trading 1 or 100. So take your time, continue to learn, grow, get better at understanding markets, get better at understanding yourself, LT. But you seem to have a pretty good handle on things. Just try not to go too fast. Make sure you're nice and comfortable where you are before you take that next step. Everybody always wants to, you know, get past that level, or what is it that I'm looking for? Push their limits, get better and bigger. But doing so too quickly, like not over leveraging, is something that that a lot of folks tend to do. I think we all tend to over leverage too quickly. So again, take your time. You're doing good. Keep doing that, and you'll know, I think, when you're ready to add another contract or two to your strategy. You're a smart guy, LT.
Yeah, and just to add to that, if it starts, once you add, there is that major psychological barrier, and I know some traders just struggle once they get to a certain limit. Don't be hesitant to get back and revert to where you were. Nothing wrong with finding what works and sticking to it. If you go from 1 to 2 and all of a sudden at 2 you're really struggling with the risk you're taking, bring it back to 1 and focus there, grow again, and then you can make that step again. So once you go to 2 doesn't mean you can never go back to 1, is essentially what I'm saying.
Absolutely. We take 2 steps forward, take 1 step back, take 2 steps forward, take 1 step back, take 2 steps forward, 1 step back. You know, it never ceased to amaze me that whenever I started to push the envelope, I usually ended up in a drawdown. And there's more to the just being in a drawdown than trying to push the envelope. It's a comfort level and it's a confidence level. So you got this, LT.
Absolutely.
So I got another question here. Dan, maybe you'll be good to take a look at this one. I don't know much about your trading service. Can you provide a high-level view?
Absolutely. With TopStep, you can trade futures and FX. We have all different account sizes, again, all different experience levels. The way it works is you come to us, you sign up, you pay a monthly subscription. With that subscription, you're going to get a trading combine. That trading combine has certain rules around it, loss limits, contract size, and you have to achieve a certain profit target per account size that you choose. When you achieve that profit target the first time, you're going to go from step 1 to step 2. In step 2, we're going to add a couple more rules. We're going to have a weekly loss limit. We're going to kind of limit that contract size, and we're going to call it a scaling plan. So as you grow that account balance, you're going to get more leverage to trade with. Again, you're going to hit that profit target. Once you hit that profit target, that second time, you'll then be eligible for the funded account. You'll get an email end of that day saying, here's all the information, here's all the paperwork you need to fill out. When you fill out that paperwork, we're going to give you a live account. You will be trading our money, and you get to keep the first 5,000, 100% of the first 5,000 you withdraw. After that, it's an 80-20 split. You'll keep 80%, we keep 20%. And that is a high-level overview of the trading combine. You will start a simulated account. You'll do the step 1 and step 2 in simulation. And then in step 3, or the funded level, that's the live account.
Awesome. Thank you, Dan.
Yep.
One other question here is, can we use NinjaTrader? Absolutely, 100%. NinjaTrader gives us a license key that you can use for free to get through the trading combine. Once you are going into the live account, you are going to have to either lease or buy a license from NinjaTrader. But yes, NinjaTrader is one of the more popular trading platforms in the trading combine. We have, I think, 10 different at least 10 different trading platforms that you can use in the trading combine, and they are listed on the website.
Yep.
All right, that looks like it for the questions. We're about 3 minutes short. Do you want to sing a song?
My voice is terrible.
Mine as well. So, well, I think unless we get another question here, I think we're in good shape here. We want to say thank you for joining us. Hopefully, there was something to take away for you to use in your trading, and hopefully a little bit of entertainment too. It was a busy trading day, lots going on in these markets, and it's going to be going on for quite some time. I think we've seen a lot of good opportunities, especially for summer trading. We're coming into August. A lot of Europe is going to be taking some time off, but I think they're the ones that are going to be missing out, not us.
Couldn't agree more.
Hi, guys. Thank you all for the webinar, the information, and for spending some time with us this afternoon.
Absolutely. Thanks for having us.
Thanks for having us. Trade well, everybody.